Hey, welcome everybody to Wall Street Reporter's next super stock live stream. Today is a milestone occasion. We have one of our first next super stocks about to become a super stock. I have the NASDAQ symbol up there. That's actually effective next week, next Monday. So that is the deal. It's the real deal right now. NASDAQ, SLHG. If you're watching this video next Tuesday, you'll be able to buy the stock on NASDAQ. Brad, congratulations on that, first of all.
Thanks, Jack. Appreciate it. I'm excited. Looking forward to it.
So this is, so you got great things starting to happen now. You got the NASDAQ next week, but right now, there's a bunch of exciting news. Today I want to kind of maybe start off with today's news about the clinical research aspect of the business, which is something we haven't talked a lot. We talked about it a little bit a few months ago because I think it's a very compelling aspect, which is it's incremental revenue. It's not your main business, but it's like a super high margin business, which is very valuable. It's like free money basically, which could be a huge business. I want to get into that. So for anybody that's just watching this, just give us a quick recap. In a nutshell, what is the business of Skylight? What do you do exactly?
Okay, yeah, for sure. So Skylight's a U.S. focused primary care and healthcare technology company. So our business model is really focused on this opportunity to take through acquisition and a very aggressive M&A strategy, acquiring primary care physician practices in the U.S. So family doctors' offices. And we basically benefit in two ways from this acquisition. One is sort of a public market value arbitrage where we buy these practices very favorably, usually at less than 1x revenue. And then on the market, the multiples for Skylight are well over 5x revenue. And so there's immediate value arbitrage in this acquisition model from what we buy to what we're valued at. And then the second value arbitrage, which is really kind of the big growth model here, is we are able to bring in the technology and capabilities, and we help these practices change what's called as a reimbursement model. So the way that they're paid from health insurance companies. And that reimbursement change ultimately leads to like a 500% plus improvement in revenue from what these practices are doing. And so you can buy a practice for less than $2 million, and that practice has within it, well over 10 million plus in revenue potential just in this conversion. And this conversion is being led by the insurance companies. So it's not something that we have to necessarily validate and prove. These are proven models, and we've got major peers in the market today that are validating this every day. And what Skylight's doing is very much unique in its approach to these independent practices, bringing them together and then ultimately shifting them to this second value arbitrage. It's called the patient value arbitrage that ultimately results in massive organic revenue growth for the company.
Okay, so I always like you to explain, start off with this model because it's such an exciting model, and in the opportunity, we've seen this. This is like, this is when people have this model that really in certain industries it really works when you have it like really set up like this, where you have like these double arbitrage opportunities. You have first you're buying them cheap, then you got the public. So in other words, you're paying 1x, it's really becomes worth 5x as a public company. Then organically, you're able to increase the revenues by 10x. So now you have basically you paid $1 million for a business that's worth 10 million, and that's generating 10 million in revenues. Now the market could value that at 10x, so 100. So essentially, you're like an alchemist. You can turn $1 million roughly into 100 million. I mean, more or less.
And if you look at our past performance, Jack, in the last 8 months, that's pretty much what we've been doing, right? And we've raised, with the last bought deal that we did, we've probably raised a little over $30 million now. And with a full execution of that capital into the pipeline, that's going to bring in north of 50 million plus in revenues. And that's just based on a simple acquisition model today. Now, in that model of acquisitions sits a potential for over 300 to 500 million in revenues from this conversion opportunity. And so, the cost of capital for us becomes cheaper and cheaper the more we continue to execute on it.
It's a virtuous cycle. I mean, this is what made like Amazon successful. Okay, so the existing business, what you have right now, could generate 300 million plus in revenue.
Just sitting on the existing patient base
organically.
And that's not even the full patient base. That's just a percentage of our current patients. So I mean, the full percentage is even higher. But even if we go with a conservative 20 to 30% of those patients converted, yeah, that's the potential.
Okay, so really, and the market could value this like 10x plus. I mean, and I want to address some of the comps, because now what's exciting, what makes this is such a great timing is you have a bunch of companies kind of in the space. There was some recent IPOs. There's more, so this kind of space that you're in is gaining traction with institutions. I mean, and you had that One Medical, you had the Oak Street, and you have a couple of new guys. So I think what that's going to do is that's going to attract eyeballs for institutions who are looking for, okay, how do we get in on the next one on the ground floor, which is still undervalued, on a relative basis, and which has the upside, and of course they got the great CEO, because it's really the CEO. At the end of the day, listen, we can talk about valuation. I've been doing this a long time. It's really the CEO of any company. You have a great CEO that can turn something which is a piece of crap into a blue chip $1 trillion business. I mean, they can start with one business and become something. The business doesn't matter. So this is the great thing, which is, I mean, I think you're bringing a lot of value to this, and I think once you start doing that institutional roadshow, really getting out to more investors, you're going to be a superstar. I don't want this to go to your head. I'm not trying to butter you up. I'm telling you the reality. Okay, so what have you done lately?
Yeah. So look, I appreciate that, Jack, and I'll be the first to say, great CEO, but I wouldn't be able to do it without my team. So we gotta go hands down to one of the best possible A category teams we have on the on the group today. And man, Q1 was just phenomenal for us in finding some exceptional talent on board. So like, I sleep better at night knowing that I got a team behind me that's going to continue to execute what we're going to do. But look, I think what a lot of people need to, I think what they see in Skylight's opportunity, and this, let's talk about this valuation opportunity that Skylight has just on the US side, right? So you're right. You've got companies like Oak Street Health, Agilon, Privia, and you've got more companies that will come to market this year. Right. And there's really kind of two opportunities here. Number one, most of these companies are private equity backed. And so by the time they come to the market where the public can participate in these stocks, they're already valued at 5 billion plus. And so a lot of people lose that opportunity to get that 10x growth, through a company's growth phase. Right. And so Skylight's coming in at a $200 million market cap. And we have all the structure and sort of roadmap from our perspective to achieve what these companies are doing. Now, they've been doing it a lot longer, but as we continue to execute, you've got investors having an opportunity to come in on the ground floor. And that's really attractive, and that's not common, especially in healthcare companies on the US side, right? So that's number one. Number two, if you look at the valuation of these companies, if you're an M&A focused roll-up player, like a company like Cano Health today, they haven't gone public yet, but their values are at about 5 to 7 times revenue, right? But their value post-acquisition is barely nothing. It's just you have to keep acquiring to keep keeping your value going. But then when you look at companies like Oak Street and Agilon and Privia, and you see their multiples at north of 10 times, it's because of the organic growth they get. So if you look at the double opportunity that Skylight brings, as a roll-up player, you do get that valuation difference from acquisition. But then as an organic growth player, you do get that opportunity to now have investors and analysts value you on a much higher revenue multiple because of organic. And so this is why I think, just from a market perspective, there were always kind of two reasons why we felt here's why our stock doesn't compete against those of our peers. Number one, we're not on the right exchange. Number two, our revenue recognition today is in the fee-for-service model. And as we execute in the conversion of value-based care, you start to get recognition for that revenue. So we're achieving number one by getting onto the NASDAQ next Monday. And then we're going to be able to achieve number two this quarter, as we're going to start to announce how and these contracts are coming in and what these contracts are that are converting these patients over. And what better place to do it now on the exchange where our peers are receiving these much higher multiples. So we certainly think that this is going to be an opportunity, just from a valuation perspective, to see a closing of the gap.
Yeah, and I think so speaking of, so there's, I think an important distinction is, that investors need to understand is, there's, when people think about roll-ups or whatever, sure, the healthcare business is a huge opportunity. It's $1 trillion business in the US, or whatever it is. There's a distinction between just doing, roll-ups, that's it, or where you're really driving that organic growth, because that's really where the value is. That's where, people are paying the top dollar. Speaking of which, you had today's news, which is the clinical trials business, which is, we haven't talked about that before. It's kind of something you mentioned back, I think in February,
That's
we
right.
talked about a little bit, which
Right.
I think is it's a phenomenal business, which, right now it's just a small part of it, but I think ultimately you have the platform, you really have a platform, because Skylight has this incredible platform where you could really make that a massive business, which, I mean, it could be worth more, it could generate more revenues than what you're doing right now by itself. I mean, it's a huge opportunity. So and this is your first deal that you announced today, right? This is the first actual contract. So we talked about it. We haven't really talked about it in the last few months. This is only we mentioned it. And
yeah,
please explain what the business is, and then we'll go into today's contract.
Yeah, for sure. So, I think if you recall back in February, we talked about this partnership with ClinicEdge. And, I think what a lot of people, understand if you're in the clinical trial space and should understand if you're not is for any drug company that wants to introduce a new product in the market. Remember, our history and roots prior to Skylight spent a lot of time on the research side, right? So we have a lot of assets built already, and we have a lot of tools and capabilities from both a people and technology perspective to support companies on research trials. And so if you look at the cost and time that is the greatest in terms of a clinical trial, it is in the identification and recruitment of patients into a clinical trial, right? And the data access. And very early on in our sort of early debuts, I used to talk a lot and compare against companies that effectively have basically sold into drug companies for a value of data, right? And these values have been anywhere from kind of $2,000 a patient, and that's how you can value a patient base in terms of access points, right? And so I think the notion that this continues to still be a huge problem is identification and recruitment. You're right. We have a massive platform. And if you look at companies in the US today that run healthcare services, it's not uncommon to find that they're doing, in some cases, hundreds of clinical trials at the same time, because it's not like they themselves are the clinical trial company. They're just providing access to the patients through their network. They have a few amount of costs. Their margins are extremely high, and the drug companies pay for the majority of expenses tied to the clinical trial. But it's a passive revenue opportunity that's meaningful. And so, as we think about Skylight,
it's like you have this, you have an office building near a highway, and now you're able to put up a billboard. So the billboard can actually make you as much money in monthly rent as the space. It's like,
yeah. So if you think about this partnership with ClinicEdge, I mean, the reason
it doesn't cost you anything, basically.
No, it doesn't. It doesn't cost. It doesn't distract us. It actually has us say, look, we're more so motivated to keep building the largest network possible because there's other opportunities that we can find to create, parallel revenue streams. And so if you look at execution from our side, we signed the agreement with ClinicEdge. We started on multiple clinical trial applications. I'd say today we've got, well over 15 applications with different drug companies. And these are companies that range from biotech companies all the way to traditional drug companies like Pfizer and GSK, right? And so the odds of winning these trials is very competitive. But there's so many of them that we continue to just maintain that ongoing pipeline of proposals. And so this first one that we've got here with Adagio, this is a biotech company. This one specifically is for an antibody test for COVID-19. Certainly not our focus, but a trial, right? So it's an access to a trial. And I'll give you an idea. This one trial where we have about 100 patients now for this trial, we'll expect, and although not reported, so far, but we'll expect north of $1 million in revenue on this one trial, right? Just this one trial alone.
And what kind of margins do you have on that?
Our margins are like 60 to 70%. So, this is consider this one of 15 that we've applied for, and we're consistently applying for more trials. Now, we may not get all 15 right away, but when you get one, you get credibility for the second one. And so I can certainly see that our research team are going to be pretty successful in at least getting a few more this year. And this is going to be, continue to be announced. Now, it's not to say that all of a sudden we're shifting to become a research company. No, it means that this opportunity only becomes more possible the bigger Skylight Health grows as a primary care network. And so it allows us to play in more opportunities for different types of drug trials. It could be a diabetes trial, it could be a cardiovascular trial. So, the notion that having this as a base of business, that we are now starting to prove parallel revenue streams, is only more meaningful to the organic growth potential of Skylight. This is a non-dilutive form of growth that is supported by the acquisition and organic growth story. So we're really excited because, it is with a major biotech company. It is from a grant perspective, meaningful revenue. Now, this trial alone, we only have 100 patients to start with out of one research site, and there's nothing limiting us from getting additional research sites under the same trial. So we could see the number of patients increase. And in fact, from a patient perspective, I mean, the remuneration is substantial, and it validates significantly the cost and, the willingness for companies to pay for access for patient recruitment. So, we're just really excited by the news. It speaks to the execution of our research team with their partnership with ClinEdge. And like I said, it's our team that's leading this way forward. So, huge congrats to them. And I'm certainly looking forward to having more of these really good announcements this year.
Okay, so yeah, and again, the more, the bigger your patient network is, the more, it's a success cycle. So let's say right now you have about 100,000 plus patients in the U.S., right?
Yeah, I mean, we've got close to about 150,000 patients. Over 70,000 of those were probably brought in over the last 6 months. Actually, probably a little bit more than 150 now, but okay.
Yeah. And now, we're going to talk about the next topic, of course, which is the exciting one, is the M&A pipeline. But yeah, so let's say when you get to 1 million patients, which is not really that far away. If you're at 175, it's only like a 5x. It's not a big leap. But at 1 million patients, all of a sudden you have a much larger database, which you can recruit patients into clinical trials. So, how big do you think this clinical trials business could be inside of Skylight?
I mean, look, if you estimate it, I think that if we look at sort of future potential, like the per revenue patient in a clinical trial can be anywhere from, a few thousand to 15,000 to 20,000 per patient per trial, right? So it's a range, but it's a substantial amount. I think it's fair to assume that if we put more of a heavy emphasis on research, and even today, if you look at it today, you've got 15 clinical trial applications out there. And, the average revenue per trial is about $1 million a trial. Could you average about 15 million today on a base of patients? And as you continue to grow and have more of that credibility, because, reputation allows you to get more trials in the door, and you gain more experience with the drug companies. I think this could be really a substantial form of revenue that, as we continue to build on the primary care side, I mean, today alone on potential of that revenue, it sits on, a little less than 50% of our guidance for this year. I mean, that's pretty significant, especially something that has such high margins in a business model. But again,
I don't think it's
on the core.
And it's not really baked into the stock because nobody has thought about it.
We don't put it into guidance. We don't put it into valuation. Really, it's one of those things that's just going to prove itself in the numbers as we start to report.
Yeah, it's like you're getting an extra. It's like a freebie right here. Yes, so a lot of, I mean, this stock has so many catalysts which can really, drive that valuation. I mean, it's like almost too many to list. You have
and Jack, I'd say even from an organic growth perspective, even the conversion to value-based care, that's not factored in today. If you look at our multiples today on the business compared to the peers on the US side, we're receiving almost a little bit less than the valuation multiples placed on just M&A roll-up plays, not even the value creation. So, the way I see it today is value creation is not even baked into the multiples today. So I think that there's just a ton of opportunity, and broader audiences are going to lead to more exposure to that opportunity.
Okay, so let's jump into kind of the exciting thing that everybody wants to hear about is the acquisitions pipeline.
Yeah.
So again, that's kind of the big story is how fast, how big can you scale, Skylight with these acquisitions. So what's the latest? What's the update on the pipeline right now?
So, this has been a bit of a challenge for me because you've known us. We've wanted to come out with news really frequently on deals, and I've had deals sitting in the pipeline that needed to have closed. But look, the administrational work required for the NASDAQ uplisting takes a lot of time. And, more than anything else, I wanted to make sure that, we have the right market, you have the right audience. And as you execute this cadence of acquisitions, you've got people that are going to pay attention to it. So, what I will say is we're getting impatient ourselves. And now that we have, the NASDAQ date sort of fixed for Monday next week, and we'll be able to more formally announce that post Thursday after close, which is the 5th trading day that you're allowed to now officially announce the affirmative date, but they have put us in the calendar now for next Monday for trading. expect that we will be rolling out acquisitions starting next week. Now, we moved away from LOIs, right? So anything we announce now are going to be closed acquisitions that will reflect in that quarter on the P&L. So, I've got a little over 4 deals now that I need to close very quickly. And we've been sort of pushing and moving them along based on some diligence work and timing. And so, we're going to be, what I would tell people is, look, we've been holding off for a little bit because we had to get through this NASDAQ uplisting was the #1 priority. But expect news flow to start rolling out next week, and expect a very steady cadence of news flow, very similar to how we used to do it before. I wouldn't be surprised if we doubled our number of acquisitions here before the end of this year. My biggest problem today is working with the team to make sure that we have enough teams in place to speed that up, because the number of deals in the pipeline are going to keep us busy well into the following year right now. So, and we're not even through the end of this year. So there's just a ton of opportunity. We're obviously well cashed up now from the last deal that we did. And so, we're going to go right back on M&A growth mode starting next week once we get this uplisting completed.
So for the going forward, you're not going to be announcing LOIs. You're just going to announce when the deal is closed, essentially.
Yeah, you know what? It's more exciting to announce closed deals. Look, LOIs have a sense of closing risk, and why do that? Plus, why? The other problem, Jack, for us is, we negotiate deals pretty much right until the close, right? And so once you announce a deal on an LOI, look, the buyers, the sellers kind of have you. So, we like the flexibility to be able to have that. And often what happens, Jack, is when we're in a diligence of a deal for 60 days, within 30, 2 might pop up and we go, you know what? We like those 2 better. And so we will be able to now move acquisitions around based on what we think is the higher quality target. And we're at such a large opportunity pipeline today that, quite honestly, we're sitting on quite amount of selection, right? We can be highly selective right now.
Okay. So we're going to jump into some audience questions in just a second. So the bottom line is, though, even though you have a couple of other companies coming into the space, they're going to be public, these private equity backed players getting into the healthcare space. It's still a vast, a vast open wide market. This, what is it, $1 trillion plus? Is there enough for everybody right now? Is there enough?
Look, here's what we get the best.
I should say, is there enough good potential deals for everybody?
Yeah. Because look, no one's buying the guys we're buying, right? One of the bankers, and I don't say this to sort of hype us up, but one of the bankers, and I'm talking one of the larger broker dealer bankers in the U.S., dubbed Skylight as a white knight for primary care clinics, right? Because they're like, look, you've got these independent practices. They're way too small to be acquired by these large, multi-billion-dollar public companies. Private equity doesn't care about deals that size. And really, these physicians are going, look, we need someone to come in and help us as a business make this move into this new reimbursement model. And there's really nobody there. And if you talk to the payers are going, our biggest challenge are these smaller clinics, because nobody's focusing on them. And so, look, I don't think we have a lot of competition in where we play. I don't see a lot of competition in where we play. When we go into these deals, everybody says there's other deals on the table. But we've only, knock on wood, lost one so far. And that was to a guy that had to sell his practice to a local hospital system because he wanted to continue working there. But, we don't have a lot of competition. So from our perspective, it's a wide open market. Even then, I've said this before, it's like an all-you-can-eat buffet, right? We're going to continue to be really aggressive here, but there's still so much room for everybody else to play. Because of that, the prices will remain disciplined. We can remain disciplined. And what we're buying isn't valued at the price we pay. What we're buying is valued at that 5 to 10x that we're going to turn this practice into by coming in and doing what we do at Skylight Health. So that's continuing to resonate. And that's why we're seeing the deal flow we're seeing, because it's proving itself out.
Okay, so right now, so just to recap, so the current run rate of Skylight is how much?
Well, on a run rate basis, I'd say we're about 56 million.
50, okay, so right now,
guidance we give the calendar year is about 40, but that doesn't include full year acquisitions that we've done, and that doesn't include the acquisitions we have in LOI today. That doesn't include the acquisitions that are sitting to get into LOI today. It doesn't include the organic growth that'll come from the conversion. It doesn't include any organic growth that comes from parallel revenue streams like the clinical trial business. So all of this is, the way I say it today is, if you're an investor coming into Skylight Health, what you're buying into is you're buying into an M&A story that has not been valued yet for any organic growth. And so we continue to validate. We've got the cash. We're going to make acquisitions. So you're de-risked from what you're buying. And then anything else you get in terms of organic growth is all kind of future opportunity that you're not paying for today. And so that's what I want to do. I want to make sure that everybody gets that opportunity to say, we're de-risked in what we're buying, and we have this tremendous upside if management executes on what they're going to do. And that's our model. We got to execute, and that's what we said at the start of this year. It's all about execution.
Yeah, and that's, it's funny actually. So when you first came onto our platform, I think was it in late November? So well, yeah. So you've done everything you said you were going to do. I mean, we didn't even talk about NASDAQ. NASDAQ wasn't even in the cards at that. It was like, now it's going to be next week. Okay, so now one of the things you said you wanted to exit this year with a 200 million plus run rate. Are we still on track for that?
I think we already have that with our organic growth potential and our acquisitions done today. I mean, look, I'm sitting at well over 300 million potential with the conversions in our business. The revenues in the space are not little, right? When you've got companies like Oak Street posting 1.5 billion for the year, and they're sitting on what, about 89,000, 90,000 patients. By the end of this year, we'll have more than double that count of patients in our network. And while their revenues are tied to the older fee for service, remember those patients are Skylight patients. And as we convert them into the fee for service, into the capitation model that Oak Street plays in, those are the revenues that Skylight will start to recognize from the insurance company. So
you want to, Pride, why don't you repeat that comp once more? So let it sink into people so they can understand. So, OSH has been a pretty hot stock.
Yeah, I mean, so you've got Oak Street. So this year, I think they're saying what, about 1.5 billion in revenue is their expected revenue for this year, and they will do that on approximately 90,000 patients.
And you have 150,000 plus right now.
150,000 plus. I mean, by the end of this year, I'm pretty certain we'll cross 200,000. So, you cross 200,000 patients, and you factor in the fact that if even 10% of those patients convert into value-based care, we're talking about over 20,000 patients here. The revenue potential here is massive, right? And Oak Street has been doing this for 9 years. Skylight's been doing this for 8 months. So our rate of growth is so much faster.
I think that's the key thing. That's the real key takeaway. Is the story part of the story is the rate of growth. Is right. The dynamics of the story is that once it starts like really trading on NASDAQ, then it's like people say, wow, these guys are closing deals. They can model out that future revenue. There are those organic, so if you do 200 million revenues, potentially you could have a 2 billion valuation by December. I mean, 200 million run rate we're talking about. I mean, when you hit that run rate.
Yeah, I mean, look, I think that our multiple should be higher than 10x if we hit that kind of organic growth. I mean, where do you find
because of the growth rate of the revenues, essentially.
Correct. Yeah. This is a revenue multiple business. I mean, the 800-pound gorilla in the room, Oak Street Health, is a revenue multiple business. The company is posting massive losses every quarter. It's a revenue multiple business. Agilon, same thing. I mean, these companies are all being valued on revenue, and it's coming from the drive in organic growth. But keep in mind, most of their organic growth comes from value-based care conversion or acquisition of companies that are already doing it. So what's different between their model and Skylight Health's model? Nothing. The only difference is we're buying practices today that are unattractive to them. But these companies, if I buy them at a 4 times EBITDA multiple, and if my only business was to convert them and then sell them again, those guys would be buying them for me for 15 times EBITDA. So, that's just that's the price that you pay for a practice that's already made the conversion. So what Skylight's doing is just catching these deals earlier and realizing that potential post-acquisition.
Okay. So the bottom line is if you can get to that 200 million revenue, that run rate, you'd have a 2 billion. So basically it's a 10x from here because the market cap of a couple hundred million right now, 200 million right. Ballpark. So it's a 10x plus potentially in the next, we're in June already. That's 6 months. In 6 months, you could be at 10x.
Yeah. I mean, look, for me, I think
we've had stocks go up 50x in 4 months. I mean, I don't see why you can't go up a 10x from here.
No, Skylight's already gone up 10x since, when was it? September of last year, more than 10x in September of last year. We're used to a certain pace of growth now, and we're going to want to make sure that we keep driving that. Look, at the end of the day, this is a market that has so much opportunity for growth. And the last 8 months, we have built a patient panel larger than some of our biggest peers in the market today that are valued at over $10 billion. And if you give me another 8 months, I will try and double that patient count for you. So, our goal here is to step down, focus hard on execution and make sure that, we're mindful of how we finance these things. We're mindful of how we utilize cash capital for acquisitions. And if at any point in time acquisitions is not the formidable form of growth, remember there is a ton of organic potential within this company as well that is actually bigger than any acquisition model that we can build.
Okay, let's see if we have. We'll go to a couple of questions, and I think we have time for like three questions here. Okay, let's go to Bob. I think he has another one. Okay, so Pratt, how are you planning to fund the new acquisition, stock or debt?
So we've used stock most of the time now, right? I mean, we haven't raised any debt yet. One of the biggest differences between the Canadian market and the US market is Canadian debt providers use EBITDA trailing to be able to provide debt leverage. And so that's difficult for a growth company. The US market understands this market really well. In fact, one of the groups that we presented to was formerly senior executives from Oak Street Health. And they came over and started this debt lending business because they realized that when Oak Street was trying to raise money back in the day and they were losing money, they couldn't find it easily. And then all of a sudden, Oak Street did really well. And now suddenly you got these debt providers that are using enterprise value to be able to leverage debt against. And so, I think the turning point for us is the NASDAQ here. So crossing onto the NASDAQ allows us now to engage in these conversations with these US debt providers. That will be probably the conversation we will have now to start using debt complementary to equity. We're never going to use it as a primary form. And I'm expecting that based on demand on the US side, and keep in mind, we've had a ton of meetings on the US market, that we're going to have this continuous flow of growth. My job is to say, if we raise $1 million, I better get back 3 to 5 million in shareholder value. And then we use that to be able to continue to grow the company. We're mindful of dilution, but at the same time, this is a fast, rapid growth stock story that will be able to use future cash flows for acquisitions as well. So that's our plan moving forward.
Okay, Wayne's asking, when do you anticipate the revenue to reflect the organic growth? From the switch to value-based care. When is that going to happen?
I think you'll start to see that this year in some of the reporting quarters, probably towards the back half of this year. Look, we've already started to receive offers from health plans for taking on risk-bearing contracts for patients we have, because we've started to focus on density and size now. We've already been approached by payer groups to say, look, we want to invite you to join our health risk program and take on risk patients. So really the question for us is, making sure that we have all the right structure in place to get there. And kind of like I said on yesterday's call, on our earnings call, we're pretty comfortable to say that we'll probably get our first contract in place this quarter. And then we'll start to see those patients coming into the third quarter. But keep in mind, the model for growth in the near term is still going to be very much focused on an M&A, because there's a large market share to be had. But we are also going to be working in parallel on this conversion shift as well.
Okay. Prad, are you going to be ringing, somebody was asking, are you going to be ringing the NASDAQ bell, the virtual bell?
I would love to ring the virtual bell. I would love to ring it in person. But man, is it painful to have to cross back into Canada again after. But yeah, certainly the goal will be to do it. But the best thing would have been to have done it in person.
Okay. Okay. Let's do two. Let's see if we can do two more. That and okay, we do because we're running a bit late. Expansion potential in California. You have any business in California?
So we actually have a few conversations in California. Actually, it's one of our big market opportunities that we're seeing. So look, we're in some major markets today: Texas, Pennsylvania, Colorado, Florida. Just name a few, but California is certainly on our radar as well. We have a few groups right now that we're having a discussion with around from an M&A standpoint. So we'll keep everybody updated. But yes, all eyes on California.
Okay, excellent. Prad, always great to have you back. Look forward to having you back maybe in about 2 weeks when you're officially on NASDAQ, and hopefully you might have some big announcements by then. So set the stage for the next next level of growth. Okay, Prad, thank you again.
All right, Jack. Thanks for having me. Always glad to be here.